America's favorite chicken chain went from Wall Street's biggest obsession to a complete ghost town. In the mid-90s, Boston Market opened a new restaurant every single business day, while its stock doubled overnight and families lined up around the block for that famous rotisserie gold. Executives were building a financial house of cards destined to collapse behind the scenes. This narrative covers the journey from a billion-dollar empire to just 16 lonely stores left in 2025. The story began in 1985 on the streets of Newton, Massachusetts, where the aroma of garlic and herbs drifted from a small storefront called Boston Chicken. Arthur Kors and Stephen Colo simply wanted to sell well-marinated rotisserie birds, rather than build a massive empire. The plan worked because people were tired of greasy, deep-fried fast food. They sold home replacement meals, which was a new concept at the time. The lines were long and the food was fresh, so it seemed they had solved the American dinner dilemma. That local charm soon attracted some very big investors. George Nadaff walked into the store in 1989. Nadaff was known in the business world as the man who discovered Kentucky Fried Chicken and bought the rights to the New England territory. He took one bite of the chicken and saw immediate profit potential in the long line of customers. He bought the company quickly and transformed Boston Chicken from a local shop into a scalable machine. He wanted a complete industry overhaul rather than just a few stores. By 1992, they moved the headquarters to Golden, Colorado, and brought in former Blockbuster Video executive Scott Beck. The plan was to expand fast and dominate the market without looking back. Unfortunately, they were running straight toward financial disaster. Boston Chicken went public on November 9, 1993, and Wall Street reacted with intense enthusiasm. The stock priced at $20 soared to $48.50 by the closing bell. It became the most successful IPO of the year, with a 143% jump in a single day. Investors threw money at the company because they believed it was the next McDonald's. The cash influx allowed them to open hundreds of locations quickly. Maintaining that stock price required constant growth, regardless of the cost. Executives faced immense pressure and began making decisions that prioritized speed over stability. Problems emerged by 1995, so the company attempted to cover them with a name change from Boston Chicken to Boston Market. They wanted to sell turkey and ham and meatloaf alongside the chicken. This attempt to capture the lunch crowd proved to be a logistical nightmare. Every new menu item required new equipment and more training, which slowed down service. The simple rotisserie operation turned into a complex factory line of side dishes and meats. The menu grew while the focus blurred, and customers became confused by the volume of options. Competitors also arrived, as supermarkets like Costco and Kroger installed their own rotisserie ovens to sell chickens for $5. Boston Market could not compete with that price. The corporate strategy relied on a complex financial system called area developers to open stores faster than anyone else. Boston Market lent massive amounts of money to franchise owners to build new stores. The corporate office recorded those loans as revenue on their own books. They were effectively counting money they had lent to themselves. Revenue looked impressive as long as new stores kept opening. That revenue vanished when those stores struggled to pay back the loans. One analyst examined their books and predicted the inevitable collapse. The company reported record profits, while its actual cash flow drained away. The financial structure collapsed in 1997. Franchisees carried heavy debt from corporate loans and could not make their payments. Boston Market's recorded revenue disappeared when they defaulted. The stock that once traded at over $40 fell to under $1. Shareholders were furious and filed numerous lawsuits. Boston Market filed for Chapter 11 bankruptcy on October 5, 1998. The company had burned through $1 billion of investor money and had nothing to show for it except empty stores and angry creditors. Thousands of employees lost their jobs as the company closed hundreds of locations. The era of rapid expansion had ended. McDonald's purchased the entire Boston Market brand in 2000 for just over $170 million. This amount was small relative to their overall budget. McDonald's valued the real estate, but also attempted to fix the operations. They simplified the kitchen and reduced the menu size, which made the remaining stores profitable again. Boston Market operated as a quiet and stable subsidiary for 7 years. McDonald's eventually struggled to integrate rotisserie chicken into their business model and decided to sell the chain in 2007. Sun Capital Partners acquired the chain from McDonald's. The brand declined slowly over the next 13 years. Boston Market existed in a stagnant state with neither massive expansion nor total collapse. Quality dipped while prices crept up and the brand lost relevance. Stores in the 2010s often featured empty parking lots and outdated decor. Chains like Chipotle and Sweetgreen reinvented fast casual dining, while Boston Market failed to modernize. Sun Capital kept the business alive to extract remaining cash flow until they could find a buyer to take the burden. Businessman Jay Pandia bought the company in April 2020. The former Pizza Hut franchisee promised a period of renewal. He proposed a plan called Boston Market Connect to open locations inside gas stations and delis. He discussed aggressive expansion even as other businesses closed down during the pandemic. The comeback seemed plausible for a short time. Problems emerged quickly when vendors complained about unpaid invoices. Landlords reported missed rent checks. The aggressive expansion announcements served as a distraction from the financial instability. The acquisition accelerated the company's decline rather than rescuing it. The situation inside the stores became surreal by 2022. Customers often walked in for dinner and found no chicken or sides available. The company had stopped paying its bills. U.S. Foods sued Boston Market after claiming they were owed over $11 million. The distributor stopped delivering food, which left the chain unable to buy ingredients. Employees often ran to local supermarkets to purchase chicken and potatoes to keep the locations operating. The chaos demonstrated that the corporate structure had failed completely. Conditions deteriorated further in May 2023. Local authorities in Colorado seized the Boston Market corporate headquarters due to over $300 dozen in unpaid taxes. The building in Golden, Colorado was locked up. Owner Jay Pandia appeared unaffected because he was already operating the company remotely. The loss of the physical headquarters was simply another problem among many. Lawsuits accumulated from landlords and vendors and employees. The restaurant staff suffered the most from this collapse. The Department of Labor launched an investigation in late 2023 after receiving complaints about unpaid wages. New Jersey issued a stop work order that forced 27 locations to close immediately because the company owed over $600,000 in back wages. Employees showed up to cook and serve customers without receiving their paychecks. The workforce faced a total lack of support. Morale disappeared completely. The few remaining managers tried to run restaurants without inventory or payroll. A strange event occurred while the U.S. operations collapsed. News surfaced in late 2024 that a new restaurant called Boston Chicken India had opened in New Delhi. The ownership attempted to launch an international expansion while American landlords evicted stores for unpaid rent. The U.S. stores dwindled to double digits while a new location opened internationally. This disconnect baffled industry analysts. It remains unclear whether this was a genuine attempt at survival or simply a strange final chapter for the brand. Owner Jay Pandia attempted to file for personal bankruptcy multiple times throughout 2024 to shield himself from the debt. The courts dismissed his filings and left him exposed to tens of millions of dollars in judgments. Procedural errors and a lack of transparency in his filings resulted in a lack of bankruptcy protection. Creditors fought over the remaining funds in the company bank accounts. Leadership became paralyzed by legal battles and left the few remaining store managers to manage the situation alone. Boston Market has almost disappeared by late 2025. The chain has fallen from a peak of 1,200 restaurants to about 16 locations scattered across the country. Many of these operate with limited hours and a reduced menu or sit with doors locked despite signs still being up. The website contains outdated information and the headquarters is gone. The employees have moved on and the rotisserie ovens are cold. This represents a significant corporate collapse caused by greed and mismanagement and neglect. The journey of Boston Market demonstrates that rapid growth does not equal a healthy business. They chased stock prices instead of customer satisfaction and manipulated financial records. The market eventually corrected itself. Only the memory remains of the golden skin and the taste of a home-cooked meal. Boston Market has effectively ceased to exist as a major brand.